Welcome once again. My name is Steven Primo. I am the president and founder of SpecialistTrading.com. For those of you who aren't aware of our website, SpecialistTrading.com offers unique education and courses in trading the stock, E-mini, and the Forex markets. So we give specified courses in each of those markets, and today we're going to talk about a great technique that you can actually use in trading, whether you're day trading, whether you're position trading, and especially use it for the Forex markets. Now, for those of you who are not familiar with my trading or what I do, I have been actively trading for the past 34 years. I began my trading on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist for Donaldson, Lefkovich, and Rett. So I learned a great deal on the floor. And even though my background is in trading stocks, everything that I learned can be easily transferred over into trading the Forex market. Now, after I left the floor, I continued to trade to manage money, and most recently, I've really heavily gotten into teaching. I've been the director of education for some online courses. I've also spoken at many conferences and webinars and been in the Stocks and Commodities magazine and interviewed. And as I said, I devote most of my time to personal trading. I really make my living off of my personal trading, as well as mentoring and teaching students in all the markets. So, as I said, even though my background is in stocks, everything I teach and pass on to you can easily be transferred into the Forex markets in any time frame and in any direction. Now, what we're going to be talking about today, the topic of today, is Forex position sizing. Now, usually I talk about strategies. I'll give you different techniques and methods to increase your odds for success in trading, but I really believe this is a topic that's overlooked. It has to do a lot with money management, and this is, in my opinion, just as important as knowing when to enter, knowing when to exit. It really is important because it's really going to elevate your trading to the next level, and so many traders really do not pay attention to their position sizing. So I'm going to show you a unique but simple formula for knowing in advance how many contracts, how many lots you should be trading, whether you're day trading, whether you're position trading. And this is a great technique that I feel is extremely important, but most traders really overlook this. So I'm going to show you exactly how to use it today. But before we begin, as always, I ask that you please take a moment to view our disclaimer. I'm going to show you the performance results using this particular method and technique, but remember, we can in no way guarantee that any of these results will be repeated in the future. So as you're taking a moment to view our disclaimer, usually I ask for the students or members to wait till the very end of the class to ask any questions, but I'm going to kind of break tradition here today. Go ahead and ask me questions as they come up, because I have no idea how long my voice is going to last, so I don't want you to wait till the end and have my voice shot. So if you get a question during the webinar, feel free to ask me, okay, and I'll answer it to the best of my ability. If you happen to come up with a question once the webinar has concluded, don't worry, I'll give you an email address as well as a phone number where you can contact us at Specialist Trading, and we can answer any questions you have, okay? So don't worry, but feel free to ask me any questions you have. Now, once again, getting back to this tool, as I said, mostly my webinars here at FX Street are dealt with strategy training and teaching you different techniques for entry and exit and stop placement. But today I want to cover something that I really feel is extremely valuable but overlooked, and that's your position sizing. It's something that you have to take into consideration into every trade, and it can be just as important as having the perfect strategy that fits your style, or knowing what market to trade or what currency pair. I know a lot of you are struggling, and this may be one of the points which is really aiding in that struggling issue. I struggled for years, even when I was on the floor. I had a really difficult time. My P&L was like a roller coaster. I would be doing fantastic for 3, 4, 5 months, and then 1 month I'd give it all back. And I continued this process for 3 or 4 years until I met some elite traders on the floor who really turned my way of trading around. And they passed on to me a lot of tips and techniques that were able to take my trading to the next level. And so I promised myself, if I ever got in a position, this is what I was going to do to other traders. So this is what I'm trying to do to you. I'm trying to really teach you the same things that were taught to me. And so my goal is to teach you how to trade with the Specialist Edge. Now, the Specialist Edge is really different from some traders' online courses or even speakers that you'll see, maybe because the Specialist Edge is rooted in simplicity. It's not rooted in how many fundamental news tips you can discern and how many markets you're trading or how many advanced indicators you're watching. It's really rooted in keeping things as simple as possible. And so this is, once again, in line with what we're going to be showing you today. Keep things as simple as possible, even your position sizing, and you automatically open a door to increase your odds for success. Okay? So this is the edge I'm trying to pass on to you that was passed on to me. I know how you feel if you've been struggling. I was there myself, and I know how difficult it is to think you've got it down, and then all of a sudden you're giving everything back. And then you'll paper trade, and everything works perfectly. And the minute you apply any real money to it, it all goes out the window. Nothing works. I know exactly what you're feeling. So I'm trying to give you tips and techniques so that you don't have to go through that. I'm going to give you two specific edges. Very important. The first one is how to properly calculate risk. Now, this is very simple. I'm sure many of you have probably heard of this, and it's very simple. It's very basic, but most people do it incorrectly. And then secondly, we're going to give you this edge, this mathematical technique, the RPS method. It's a very simple mathematical calculation that you have to come up with before each and every trade, but you must come up with this calculation before you trade. This will determine your position size. And even though I know many of you may have heard of this before, after I share it with you, you'll say, oh, sure, I've heard of that. That's nothing new. I know. The things that were taught to me were nothing new. It's more about implementing them properly and correctly and with discipline each and every time is what's more important than whether you've heard them before. But these are the two edges I'm going to pass on to you today. So let's start out with insights into position sizing. Let's figure out why most people are using the wrong, contract or lot size when they trade. First of all, too many traders are undercapitalized. I know a lot of traders think they have enough capital. A lot of traders think they have too much capital. But you really have to really come to terms with yourself and ask yourself, are you properly capitalized? If you are trading, in my opinion, these are all my opinion, my suggestions, but if you are trading, the spot currency markets, I feel you should have a minimum of $20,000 to $25,000. $50,000 would be even better. But if you're going to be trading those large units there, you should have $20,000 to $25,000 to be adequately capitalized at a minimum. If you're trading micro lots or mini lots, then you can have $5,000 to $10,000. Okay, but if you have to at least have those requirements for those specific levels, in my opinion, because it's going to be a learning curve. You're going to have times when you have difficulty. There's going to be times when you're doing well, and you just want to be adequately capitalized for this. There may be times when you go through a drawdown period. There may be times when you're having tremendous periods of success, but we just want to make sure that you have enough to stay in the game. See, when I was trading on the floor, I knew of so many traders that were multimillionaires that made tons of money in 1 or 2 months. I knew traders that during the crash of '87 became instant millionaires. And the funny thing is that 3 or 4 years later, they had lost everything. So really, it doesn't matter, if you hit home runs or you see all these advertisements about how much money you can make really quickly. That doesn't mean anything because that can just as easily be lost. What's important is that you're adequately capitalized and then you control it with your lot size. Okay? So the second thing I want to point out is that it's wrong, extremely wrong, to use discretion when deciding on your position size. Okay? Extremely wrong because you're just basically guessing. There's no reason to come into a trade and say, well, I had a loser last one, so I'm going to bet twice as much. I'll trade twice as many units, twice as many lots to make it back. Or maybe you'll do the opposite. I had a loser last time, so I better cut back on my position size because I'm scared I may not make as much. Even though it was a small loss, I don't want to lose any more. This is all discretion. And discretion basically is fear and greed. So we don't want to get those two things involved. I see a question here. What if we use high leverage account? I personally don't like to use high leverage accounts because I want to at least have that much capital there. What scares me is when you have a high leverage account, you're playing with, the house money. You want to play with your own money. And so my opinion, once again, these are all my suggestions from being in the markets for 34 years. I think you should have that much capital, hard cash in your account. Okay? You mean a high leverage Forex trade. I understand. But regardless if it's high leverage or not, you should have that much capital in your trade. And I'll explain why you need to do this when we go into this RPS formula. So in point number 2, it's wrong to use discretion. Never come into a trade and say, well, how many lots or pairs should I trade today, or, on this particular trade? If you ask yourself that question, you're automatically wrong. In my opinion, it should never be a guesswork. All right? It should always be something that's rooted in some type of structure that you came to that amount. All right? So this is where the RPS method comes into play. The RPS method, although many of you may have heard of this before, it's a simple mathematical formula, but it must be used prior to every trade. The reason why it must be used is because it takes the guesswork out. It automatically decides how many lots to trade, and you have to know that. It's almost like going into a trade and saying, well, where's your entry? Well, I don't know yet. I'll kind of just figure it out when I see it. I mean, most traders don't trade that way. I don't trade that way. I know exactly where I'm getting in, where I'm getting out, how many positions I'm carrying prior to the trade. And that's the way a professional specialist trades. And that's what I'm trying to pass on to you. So this method will automatically decide how many lots to trade. So you know exactly what your risk is. You know exactly how many lots you're in and how much you will make if you get to your target area. Okay? You see, all of this is decided before the trade. This is the beauty of this way of trading. Most traders come in saying, well, I have no idea how many lots I'm going to trade into the last second. I have no idea where I'm getting out. I really don't know where my stop is yet. And do you see how this is really an unorganized? Can you imagine any other business? Say someone owns a restaurant and they say, well, I really don't know what I'm cooking. I don't know what type of food we're going to specialize in. I really don't know what our hours are going to be. I have no idea. I really don't know who the chef is or what we're really going to use for any type of marketing. I mean, someone would say, are you nuts? That's no way to run a business. But people trade that way. People come into a trade without any insight as to position sizing, as to entry or exit. So it's too much discretion. We have to add structure. We have to add structure in terms of strategies. And when I give you webinars about strategies, I show you all the structure we use. And now I'm giving you a little structure into money managing or position size. Now the specialist edge, as I said, we're adding structure to trading, so we'll take the guesswork out. It's okay to have a little guesswork. This is sometimes as good from having experience. As I said, now that I've been trading for this long, I have a little bit of experience and I'll have a little guesswork. I'll leave room for maybe 20% discretion in my trade. Something I've seen before or something that remembered from the last trade. But I don't give the majority of my trading style to discretion. I give maybe about 75 to 80% of that to structure and then 20% to discretion. So it's okay to have a little bit, but you need a little bit of experience under your belt to be able to apply that discretion, okay? Too many traders start out their first year trading and everything is discretionary. And, there's no real structure to it at all. So this is why I really don't believe in trading rooms or chat rooms, is because you still aren't developing your own experience. You're just trading off of what someone else does, and you're not developing what you want to learn. I'm giving you all these different things and techniques so that you can put together your own plan. All right, so let's talk about percent of capital. Now, this is something I'm sure all of you have heard, and I'm sure the majority of you don't employ. You must start, as I stated earlier, you must start out with adequate amount of capital. Okay. Once again, if you're trading the spot currencies, I would say minimum 20,000. If you're trading, micro accounts or mini accounts, 5 or 10,000 is fine. Now, we always want to figure out how much we're going to risk per trade. Not how much, we have capital used in the trade, but how much we're going to risk. In other words, if we got stopped out, if we lost on the trade, how much would we be risking of that account we have? Say we have 20,000, say we have 100,000, say we have 5,000. How much of that amount would we be risking? And the normal amount is what's usually taught to people is 2%. Now, I personally like to use 1% or less. Other traders like to even go up to as high as 5%. But the normal amount, if you're trading, especially if you're just starting out, would be 2% or lower. So on any one trade, whatever your capital is, meaning that whatever cash, hard money you have in your account, only 2% of that should be at risk per trade. Okay? So if you have a $10,000 account, you should only be risking $200. If you get stopped out, your largest loss would be $200. And if you're a conservative trader, try to include the spread slippage with that. Maybe it'd be 3 or 5 pips, whatever. Try and include that if you can, if you really want to be conservative about this, okay? So this is one thing, once again, I'm sure the majority of you have heard this, the majority of you are familiar with this, and I'm guaranteed that the majority of you don't use this. And, I've talked to so many of my students and people that I'm mentoring and other traders, and they all say, oh yeah, it's all 2% rule, right? And then I ask them if they use it, and they said, well, I had a good feeling about this one, so I risked, 5 or 10%. And it may work out, but it'll be that one trade that doesn't work out where you really give back a chunk of your capital. So your risk on any trade should, on average, be only 2%. Okay? All right, so let's now to the position sizing formula. This is the RPS. This is what we talked about. You may want to get out your pencils and paper. All right, so what we want to do is, firstly, we want to determine the risk. Okay, determine the 2% risk amount of your capital. So this means you have to know how much money you have in your account. This is not the leverage. This is not how much money you're able to trade with or how much dollars you can use in theory. This is the actual hard cash you have. Determine what 2% of that is. Okay? Now, let's go to the strategy part of this plan. Decide your stop placement. So we know where we're going to get in, hopefully, but you have to decide where your stop placement is going to be. In other words, that could be maybe if you're going short, that would be the recent high or the recent low if you're long. Let's just say theoretically. So you have to know where you're going to get out. So many traders I talk to have no idea where they're going to get out if they're wrong. I know before every trade where I'm getting out if I'm wrong. This is before I even get into the trade. So you have to know where your stop placement is, and because this comes into the formula. All right, so if you're stopped out at that stop, if it's a losing trade, what would be the total dollar amount of this loss? All right, would it be $200? Would it be $500? $1,000? $2,000? You have to figure out exactly in advance, and this will come very easily after practice. How much dollar amount would you lose? Okay, now divide your $2 risk amount. In other words, this is the 2%, I should say, 2% dollar risk amount. This is the 2% of your capital by your total stopped out dollar loss amount, by how much you would have lost in that one trade. All right? And this will give you the number of lots or units to trade. And just round off to the nearest number for the proper position size. As I said, this may seem a little wordy, or maybe many of you may have heard of this before, but I just want to, have this down in writing so that you can copy this down and you can go back to it and look at it later on. And I'm going to show you how to apply this much simpler with looking at some charts and some examples, okay? So, if you're interested, you can copy this down, but this is very important. This is why we always say you have to know how much money you have in your account, and you have to determine a risk amount, which is usually 2%. And plus, you have to know where your stop is going to be, because we need to know if you're wrong, if you're stopped out with a loss, how much dollar amount would you lose if you were trading one unit, okay? All right, so let's sum this up right here real quick. This is the RPS formula. Very simple, but this is just what I explained, but looking at more of a mathematical calculation here. RPS. R equals that 2% risk amount we're talking about, okay? So if you have a $10,000 account, you're risking $200. P equals the PIP, dollar loss, if stopped out. So in other words, if, you lost $500, that's what equals P is the PIP dollar loss, okay? And then S equals the size. So what we want to do is we want to have R divided by P, and this gives us our size. We'll just round it out to the nearest number. And it's very simple. I know this may seem a little calculated and like, wow, I have to do this before every trade. In the heat of the moment here, I might lose concentration. But after practice, after doing this, maybe paper trading doing this, it's really not as difficult as it may seem. You'll get very used to it, and it'll make you a better trader because you'll be adding more structure on the money management side of your trading. Now, you can apply this to any strategy, by the way. This does not have to be one of my strategies that I teach. We have upwards of 10 strategies for Forex, but it doesn't have to be one of ours. It can be anything you've been trading already, just as long as you know your risk amount and you have a set stop in place where you know you're going to get out. All right, so let's look at an example here. All right, position sizing example. Let's say you have a $100,000 account. I'm only saying that so it'll be easier for us to do the calculation, the math. But let's say you have a $100,000 account. All right? So R, we want to determine the 2% risk dollar amount of that capital. So 2% of $100,000 is $2,000. So basically what this means is on any trade, that's the most we're ever going to lose. If we get in and we get out with a loss, our loss will never be greater than $2,000. Okay? That's our 2%. All right, so let's say we did get stopped out of the trade because we know where our stop is in advance, and so we just advantage that we got in and we got out with a loss. What would that be? This equals P, our PIP dollar loss if we're stopped out. Well, let's say we had a stop of 200 pips or $1,000. Let's just say they came out to $1,000. All right? Well, now what we do is this is R, 2,000. Or I should say, or 1,000, I'm sorry, this is 1,000 per 100 pips. It should be 2,000, I'm sorry. So 2,000 divided by 2,000 equals 1. I'm sorry, this is a typo here. This was per 100 pips, so 2,000 altogether. Very good, Phil. That's very good. I noticed the same thing myself. That's a typo. So this is 2,000 divided by 2,000. So this automatically gives us a size. We should only be trading 1 unit, okay? Now, this is a very simple example. They most of the times, won't be this easy and simple to figure out, but we're just trying to do it regardless of the typo we have here. We're trying to do it so that you understand the process, okay? So we have a $100,000 account. 2% equals 2,000. If we got stopped out at our stop level, we would lose $2,000. So we divide those 2,000 by 2,000 equals 1. Very simple, okay? Let's look at an example here in the euro dollar. This is an older chart, but we're just doing it for, educational purposes, just to explain this theory to you here. Now we have a $100,000 account trading the euro dollar. First thing we have to ask ourselves, what is our risk amount? 2%, okay? Now you may want to change this. If you're really conservative, you may say 1%. Or if you're a little bit more aggressive, you may be 3 or so. But I wouldn't suggest going up to those levels unless you're a seasoned trader, if you've been trading for a while. But if you're a beginner to intermediate, I'd say anything 2 or lower, okay? Now I've been trading for a while and I still trade only 1%, so it's really up to you. But let's say you're at the medium level, you're at 2%. All right, so that means on any trade, you're only going to risk $2,000, okay? Now, we have some type of setup. We have a strategy set up to go long the euro dollar, but we have to determine where our stop is. So this is where we're going to enter, and this is fine. This is all fine and great, but where are we going to exit if we are stopped out? Well, here's our stop right here. Remember, this is all information you need to know prior to the trade, and we teach this at Specialist Trading, where to place your stops, where to place your entries, so you know in advance where they're going to be. All right, so we're entering here, and if we're wrong, we're getting stopped out here. What's that distance, or what's that dollar amount? Well, the distance is 200 pips, okay? Now this time we have the calculation correct, so 200 pips would equal $2,000. Okay, this is the same example we went over earlier, but now we have the correct typo here. All right, so we're risking 2%, 2,000, and if we entered and got stopped out, our dollar amount would be $2,000. So we divide R by P, and this gives us S, which is 1 lot. So that's how, this is a visual explanation of what I went over earlier. This is how you decide in advance. So you would know exactly how to do this. Trying Trader is asking, what if this were micro lots? Well, you would just adjust accordingly, divided, I believe, by a 10 for the mini lots and another 10 for the micro. It's just, you would just adjust it and divide by how much they, have decreased proportionally. Okay? And that's all you do. It would be the same thing. So in other words, whatever 200 pips is on a micro account, I believe would be $20. I'm not sure because I don't trade the micros, but I believe it would be, and on the mini account would be $200. So you just adjust accordingly. Now, I imagine if you have a $100,000 account, you wouldn't be trading those. But if you have a $10,000 account, then you would just say, well, I'm only going to be risking 200. Okay? So just adjust accordingly, just divide accordingly to what the pips equal in those certain accounts. I think this is not so much a matter of knowing the calculation, as we all know math, but rather a matter of discipline. Yes, that's a very good. It's a very good point. And as you all know, if you've attended my webinars before, I'm all about discipline and structure. I want you to have a plan. Remember, once again, I have been there before. I know how you feel, and I know what it means to be doing well and then have everything go out the window. And what was explained to me is that even though I knew all these things, I had heard of this, I had heard of risk amount, I've heard about risk-reward ratios, I've heard of everything, different indicators, I wasn't applying the discipline or applying the structure properly. And I wasn't sticking to a plan, and I wasn't keeping it simple. I was trying to I thought the more complicated I made things and put more things on my trading plate, the more I would get closer to being successful. And these were actually the things that caused me to be unsuccessful. They would work for a little bit, and then they would go out the window. So this is what I'm trying to have. You have some type of structure both to your trading plan and to your money management. Aviator says, Steve, you usually show performance results based on 1 lot. Are you going to show what it would have been if you used the 2% trading rule? Well, yes. Well, when I show trading results, those are usually with looking back at for our members when I show trading results how a specific strategy did for that particular month, or going back a year or so. But those are all using just one lot, and many times in my account, what we're trading, they are in akin with the 2% rule or the 1% rule. So it all depends. But remember, you can adjust accordingly to however you have. Now, many times, the results I show would have only been based on one lot. If you traded more, if you had a better account where you were able to trade two, the results may have been different. They may have been better, they may have been worse. But I only calculate using one lot just to keep it as simple as possible. Michael says, is it 2% of each and every trade, or can you decide 2% of your account and then use that the same amount for, say, 5 trades? Yeah, it's 2% of each trade. In other words, if you have a $100,000 account, just to keep it simple, and if you have one trade, such as we're showing right here, well, this is very easy. Okay, you're risking $2,000. Now, if you have 5 trades, 5 setups, that's okay. Each one is going to be 2% or $2,000. That's all right, because that 2% is basically just keeping your account at bay. In other words, you're not going to be at the point where you're using way too much on one particular trade and a little on another. It's keeping each trade equal and each trade balanced. So if you have 5 setups, say you have a $100,000 account, each setup will have a risk of $2,000. Okay, I hope that explains your question. Michael, and then recalculate after 5 trades. Yes, and this is another thing I want to bring up. I was going to bring this up at the end. Remember, this is all based off, that's why I said you have to know the hard dollar amount of what you have in your account. Because as you see now, as you do better and better, hopefully, your account will grow. And therefore, your 2% or 3% or 1%, whatever your calculation is, will change as well. So if your account continues to grow, well, then you'll be able to risk more and more, and this will increase your lot size. So after each and every trade, you're going to recalculate what your 2% level is, okay? This is one of the beauties of this type of method. Now, as your account, let's say you go into a drawdown phase and you start to lose money, well, your risk is going to be less now because you have less in your account. Let's say it went down to $80,000. Well, your risk now would be only $1,600 per trade. Maybe you can't take the trade. That's fine. Sometimes you won't even be able to take the trade. Other times where you used to trade 2 lots, you'll only trade 1. But this is just keeping your trading position in account with your capital. Do you see the beauty of this now? You're in sync with your capital rather than just being discretionary and saying, well, I had a good week last week. I'll bet 3 times as much this week. That's a gambling mentality. And we don't want to ever get there. We want to keep it professional gamblers, not regular gamblers that just go to Vegas for the weekend, but professional gamblers use this same technique. But they've done it so many times in their head, they can just, figure it out on each and every trade. A lot of sports gamblers use this as well. Let's see. So you're compounding as your account grows. Yes, that's what we're doing. That's the beauty of it. Okay. Now, if you have a lot of trades, if you're a day trader or, an intermediate trader, you'll see a lot more opportunities to compound your account. If you're a position trader and you only trade maybe once or twice a month, well, it'll take a little bit longer, but hopefully you'll have a larger account to do that. But that's okay. This will still help your account to grow. All right. And this is what, hopefully, this was an actual trade that we had for our students at one time. This is what actually happened. So if you had one lot here, you would have had a nice trade. English has clarification. 5 times the current trades equals 10% of capital maximum. I'm not sure if I understand your question. 5 times the current trade. Yeah. Oh, I see what you mean. That means that's the 10% of your risk. In other words, yes. And that's fine. That's why we're trying to keep it at 2%. But many times I'll have a lot of trades. That's why I keep mine as close to 1% as possible, because I may have maybe 7 or 8 trades. And so I don't want to, have 20% of my capital tied up. So therefore I only have maybe 8% of my capital tied up. So yes, 10% of capital maximum that is tied up. Where we should take the targets. Well, that's another class. Remember, I'm not speaking about strategies today. I'm speaking more about money management. The target is something that's in my strategies and in my courses and membership, but we'll talk about that a little bit later. What is the acceptable drawdown, and how can we know if it is time to quit? That's another great question, Milo. I also teach it. In fact, I gave a great a lesson for our members on how to maximize. We currently, one of the things I pride myself on is that I don't, mix the numbers. And I'll be honest, when we go into drawdowns and when we, have good months, currently we've been trading the euro dollar and we've gone into a rather large drawdown, just taking the signals on face value. But I teach my members a technique, another money management technique, which would have significantly lessened your drawdown by 70%. So in other words, once again, if you lost, say, just to keep the numbers equal, if you lost, say, 10,000 on this drawdown, we taught our members how to actually only keep that drawdown to maybe $2,000. So these are all techniques and things that I teach. I'm sorry, but they're mainly for our members because this is part of the course. This is part of the extra information that you get when you become a member of Specialist Trading. Let me continue, and maybe we can help answer a lot more of your questions too, and my voice will hang in there. What's the minimum risk to reward? Well, risk to reward should always be 2 to 1, but sometimes 1.5 to 1. We have strategies that only use 1 to 1, but because they have a lot of they have a lot of occurrence and they do very well over time, they still reap rewards with just 1 to 1, but so I can't say what is the minimum, what is not. I would say if you're beginning, go for 2 to 1. But if you're a seasoned trader, if you follow a strategy like what we do, many times our first exit is 1 to 1. Okay. All right. Let's look at another example here. Let's look at the British pound. British pound here. Let's have another, just another example. We have a $100,000 account. Okay. Just to keep things simple. All right. $100,000 account. We're trading the British pound. Our risk R is 2%. Once again, that is $2,000. Our P or our pip dollar loss, once we figure out where our stop level is, we know that if we get stopped out on this trade, we're losing 100 pips or $1,000, okay, in advance. So we divide our $2,000 by P, which is 1,000. This equals 2. So now we know on this trade, before we even pull the trigger, before we even enter, we can trade 2 units. It fits our program here. So let's look at this particular example. We have a $100,000 account, once again, to keep things simple. This time we're going short the British pound on an older chart here for educational example purposes only. Our risk is 2% or $2,000. Okay? 2% of $100,000 is $2,000. All right, we're entering right here to go short. This is where our whatever strategy it is, say it's based off, technical analysis. Let's say it's based off somebody you heard in the trading room. Let's say it's based off sunspots. It doesn't matter at this point. We're not talking about strategies. We're talking about money management at this point in position size. So you enter at this point. Where's your stop going to be? You need to know, the only thing you need to know is where your stop is going to be because we need to know where we're going to get out if we're wrong. It's extremely important. We need to know where we're going to get out if we're wrong. In fact, in my opinion, any strategy you have, you should know that in advance. And so this is our stop, okay? This is our stop level right here. So this is where we're going to get out if we're wrong, all right? So that happens to calculate out to 100 pips. So if we're wrong, we're going to be losing 100 pips. And 100 pips equals $1,000, okay? So we divide R by P. Our risk is 2%, $2,000 by P equals 1,000. And that comes to 2 lots. Okay, this is another simple example, but I'm just trying to show you the basis for this process. And that after you have a little, experience in doing this, it's really not as difficult as it seems. It's just the main things that you need to know is you need to know how much risk you're going to have. It can be, 1, 2, 3, 4, 5%. I would keep it at 2. And you need to know where your stop is in advance. There's so many traders that have no idea where they're going to get out there wrong. And you need to know that. Even if it's just a mental idea, you need to know that. And as you can see, this was an actual trade that we gave our students, and it worked out fine with 2 lots. Now, we're not going to go into where the exit was or why or what it was based off of. That's for another class. All right. What if we used a different stop? All right. Now, I gave you the simple explanations here and the simple examples. What if we used a different stop on that same trade? All right. So here's where we originally entered. This is the same British pound trade we talked about. But now we have what's called an advanced stop. And we provide this as well for our members. We give them more than just one stop. We give them conservative stops and advanced stops. Now this is our advanced stop, way up here at the very top. All right. So let's say you're a conservative trader and you said, you know what, I want to, give myself a little bit more room. I want to give myself a little more. I know I'm taking on more risk, but what would the calculation be? Well, once again, I'm only risking 2%, which is 2,000. But my stop, instead of being here, I've moved it way up here. So what does that come out to? If I lost, how many pips would I lose? I would lose 200. And what does 200 pips equal in the British pound? That equals $2,000. So now I divide R by P, and now if I'm going to trade with this stop, I can only trade one lot. Okay? So do you see how this is recalculating in order to maximize your position sizing so that you're in sync with your risk and your account, rather than just saying, well, I lost last time, I better bet twice as much. See the word bet? Oh, that's a gambling mentality, a gambling word there. We're not betting at all. We're trying to be in sync with the market. So we're trying to use this technique that will really add structure so that we have some type of really nice plan on our money management, as well as a nice plan with our trading strategy. Okay, let's see. As you can see, once again, the trade worked out in our direction. Okay, now it's your turn. Get out your calculators. And you can email me back these responses or these answers if you're not quick enough. I just want to see if you're understanding the process. I'm not going to give you the answers, but I'm going to give you all the setups so you can tell me and work on these so that you can try and figure out on your own. This is something I give my students and my mentorees so that we can learn this process. And I'm going to give you the same examples right here so you can try and understand. If you're able to answer this now, that's fine. If you're not, if it doesn't make sense to you, remember you can always email us or ask me any questions. I'll get back to you as soon as possible. But after everything I've taught you today, let's look at this example. This is in the Canadian dollar. Okay, so now things are a little bit different now because now we have a little bit different dollar amount for the pips. All right, now we made it difficult too because we only have a $50,000 account. So I don't know about you, but I have to use a calculator for this. All right, we're only going to risk 2% once again. We're keeping in line with the 2% rule. All right, so we're going to risk only 2% of $50,000 now. Okay, so can you all figure out what 2% of $50,000 is? I know what it is personally, but I'm not going to tell you. It's up to you. 2% of $50,000. All right, that's how much we are going to lose on any one trade. Then we have to figure out, once we see a trade set up in the Canadian dollar, we have to know where our stop is going to be. Very important. You can't ever go into a trade at specialist trading without knowing where your stop is. You automatically know where it is. And in fact, we give you 2 or 3 different places for a stop. So you can calculate which one you want to use. And we teach you how to do that. So you have to know in advance, if you got stopped out, all right, what would be the pip dollar amount if you got stopped out? We don't know where our stop is yet. We haven't showed the trade yet, but I'll show you the chart in just a second. So we're going to divide R by P, and that will tell us our size. All right, so here we go. Here's our $50,000 account. Here's the trade in the Canadian dollar. All right, we don't know where we're getting in yet, but I think we want to go long in this particular trade. Yes. So this is our entry right here. We want to enter at 1.0375. All right, in the Canadian dollar. Remember, we have a $50,000 account. We're risking 2%. All right, but we can't trade yet because we need to know where our stop is going to be. Well, let's just say this is our stop. This is our first stop, 0.0320. Okay? So what's the first thing we have to do? We have to know that if we entered here, and if we got stopped out here, how many pips we would lose, and what that pip, most importantly, what does that pip calculation mean in a dollar amount, in a lost dollar amount, okay? So that's the first thing you have to, this is the day before we're trading here, so we realize if we entered at 375 and exited at 320, how many pips will we lose? What would our loss be pip-wise? And what does that transfer over into a lost dollar amount? Okay? Now, that's stop placement number 1. I want to give you another thing here. What if we went to stop placement number 2? A little bit more aggressive, okay? We still enter here, but instead of using this as our stop, we use this. So we enter at 375, we would exit at 150, all right? How many pips would we lose? And once we come out with a number of how many pips we lost, what would that transfer over into a lost dollar amount? Okay? Remember, whatever that lost dollar amount is, you're going to divide the 2% of this by that lost dollar amount, and that will give you your size. Now, I'm not going to give you the answers because I want you to work on this. You know, as many of you are members of my classes, and some of you are new to these webinars, but my whole thing is about teaching. I want you to understand the process. So I'm not going to give you the answers right now. You can email me. You can come up with these. If you don't even have to ask me a question. Just say the first stop was so many lots, the second stop was so many lots, and then I'll just say if you're correct or not and try to explain it to you. I just want you to understand that this is a process that you need to understand and need to actually employ in each and every trade. Okay? Yes, this is standard lot. We're just trading. In other words, if you got stopped out using one lot, all right? Just imagine you had one lot, and say you entered here and exited here, and you were trading one lot. What would one lot pip loss be, and what would that transfer over into a dollar loss for one standard lot? These are just the standard. These are the spot currency lot. Okay. Okay, that's how simple and basic it is. And as you can see, this would have been a winning trade. This was a trade that we gave to all of our students and all of the people that are members at our site that would have made money on this trade, but how much money was determined by how many lots you had. So this is why it's so important that lot size really comes into play and position sizing. All right, so let's review here. Please never ever use discretion when deciding on share size. In fact, in my opinion, you should really never use 100% discretion on anything, because discretion it's subjective. Someone can say, I think the market is going up. This is something I've seen. And you get another person seeing the exact same things, and they'll say the opposite. Oh, I think the market's going straight down. I see the Australian dollar getting killed. Another one say, no, it's going straight up now. So, it's all subjective, and this is at the roots of being discretionary. So I think you need to have some structure. This is what I teach, and this is what was taught to me. I allow for about 20 to 25% of discretion, but that'll come with experience. All right? Now, make sure your trading is adequately capitalized. Remember, if you're trading the spot currency market, you should have minimum $20,000, in my opinion. The best possible scenario would be $50,000, but $20,000 would be fine. In the beginning, you should only risk, on average, only 2% per trade, regardless of what your account is. If it's a $5,000 account or a $100,000 account. Now, as you gain more experience, you can risk more. I, as I said, have 34 years of experience. I'm only risking, on average, 1%. All right? The RPS method is a simple mathematical formula. I'm sure many of you have heard of it or seen it before, but it must be used. It doesn't matter if you've heard this for the last 20 years or you just heard it for the last 20 minutes. The point is, are you going to use it? See, that's what really makes the difference. It's all about the discipline, which someone commented on earlier. So the beauty of this is that it automatically decides how many lots you're going to trade. So you're never going to have to, sit there and wonder what you should do on the next trade. It automatically tells you right off the bat. And this will adjust accordingly as your capital changes and adjusts. As your capital grows and increases, hopefully, you'll have more room and you'll be able to trade more lots, and it'll keep increasing for you, and it'll just, compound. It'll be great. As your account gets smaller and smaller, if you go into a drawdown, well, this will decrease your size, and many times will keep you out of trades because the formula is saying do not have enough money in your account to be able to trade one lot. So what you can do is, just sit back and watch paper trade for a while until you really feel are able to add more funds, or at least maybe, increase your risk just a little bit so that you'll be able to trade when you feel you're back in sync. All right. And we teach you how to do this as well at Specialist Trading. Remember, the edge here, which I'm trying to teach you, is to add structure. We want to take guesswork out of things. So many traders lose money because of guesswork. That can work 9 times out of 10. But the 10th time, as you've seen in many of these markets, that guessing doesn't work anymore, you give back everything. And I know from experience, as I said, I was on the floor and my guesses worked fantastically until they didn't work anymore. So I know how you feel. I felt the same way until I really found out what worked, and a lot of these techniques and methods that were taught to me, and this is what I teach to my students now. So just trying to make your trading be more consistent. I'm not promising anyone home runs with this technique or anything that I teach or trade, but I am promising you ways to be more consistent. All right, so let's recap. Edge number one, we told you how to properly calculate your risk. 2% is a standard level. And then we taught you the RPS method. All right? R divided by P equals F. Your risk, which is 2%, divided by P, which is your PIP, dollar loss, equals your properly calculated lot size. Okay? So, in conclusion here, before my voice runs out, simply ask yourself, think of the losses you've had, or think of the big winners you had. What if you were able to use this technique or anything else I've taught you today? Could it have helped you? Think of the times you've had a really nice run-up, and everything you've done has been working fantastically. This could have helped you. You could have increased your position size systematically so that your account even compounded even more. All right. What if you started to go into a drawdown? Well, this would have decreased your position size, or maybe even kept you out of the market until you felt comfortable or were able to add more funds. So this is a great technique. It could have helped you tremendously, I think, in my opinion. Now, I teach tons more of techniques just like this at Specialist Trading. As you see, I offer 3 courses in stock trading, e-mini trading, and as you saw today, Forex trading. Each course comes with upwards of 10 specific strategies and techniques, such as I just shared with you today, for really fine-tuning your trading, whether it be strategies, whether it be money management, whether it be just techniques and tips for other entries or stop placement. Give you a ton of information that I've accumulated in the past nearly 35 years. Now, if you decide to become a member of Specialist Trading, here's what you're going to receive. Continued detailed instruction, just as I showed you today, numerous Forex strategies. Now, we didn't go over Forex strategies today, but we have some really great strategies that have been working great for the past year. We provide you with updates and signal alerts so that you'll know where to get in, where to place your stop, and where to get out. Weekly webinars where I give you more information just as I gave you today. Everything is archived so you can learn at your own pace. And finally, if you're a full member of Specialist Trading, this is a lifetime membership. So this is something that, we're not taking just on a monthly basis for the full membership. This is something that you'll be trading along with me as long as I'm trading. And I'll be there with you every step of the way, trading right there with you. Now, I just want to show you a couple of slides of current trades that we've taken for our members. These were all provided the night before, given us as alerts to our members. We also teach them how to spot these on their own, but while they're learning, we provide you with the signals. This was a signal we had in the Swiss franc in July. July was a rather good month for this particular strategy. This is our swing trader strategy number 5. You can see here we did very well in this particular strategy. The Australian dollar now coming into the 19th of July. We had a really nice up move in our strategy as well. And then lastly, kind of spun there too quickly. In the euro dollar, we had 2 really good short trades. These were all, once again, signals that we provide the night before, telling our students where to enter, where to exit, using one of our best strategies, which is strategy number 5. Now, I know that many of you would love to be able to take advantage of this. Our membership, though, can be costly. Our membership for the full program can be anywhere from $2,500 to $5,000. But what we're doing, especially for our FX Street members, is we're providing you for a limited time only with nightly signal alerts on a monthly basis. So we have Forex Swing Trader strategy number 5 signals. As I said, this is for a limited time only. We provide you with nightly signal alerts for $49.95 per month. So usually anywhere from 3 to 5 trades per week you'll receive nightly signals. And what we do is we provide you with the entries, the stop placement, and the exit. So you know exactly where to enter, where to place your stop, and where to exit as well. Included in this $49.95 per month are the weekly lessons such as I just gave you today. Now, each week I go over different techniques and different ways and to increase your odds for success and different methods you can apply to my strategies or any other strategies you're trading as well. And then lastly, this comes with personal email access to myself. So if you have any questions, you can always email me. Remember, this is all on a monthly basis, all this nightly signal alerts for $49.95, just as the trades you just saw that we took for our members. Now, if you want to go the full route and actually buy the yearly signal alerts, well, this is usually $4.95. But for FX Street members, we're reducing that down to $3.95. You'll receive everything here above, all the entries, stops, exits, the weekly video learning lessons that I teach you, the personal email address. As well, we give you PDFs of all the rules so that you'll understand them, because this includes the entire course. You're also going to receive the entire course. See, with the monthly signal alerts, you're just basically going to know where to get in, where to get out, but you don't understand the process behind the signal. With the $395 yearly package, this will include the entire course, and you will understand the strategy to its fullest. You'll understand why we entered and why we got out, and you'll be able to apply these techniques much better. So this comes with everything included plus the entire course. This is for a limited time only for either $395 or monthly for $49.95. Now, if you have any questions or if you're very interested in just go ahead and joining up with Specialist Trading, you can go to this website, protraderstrategies.com. Or if you have questions, as I said earlier, you can contact my trading associate, Brett, at brettm@specialisttrading.com. If you'd like to speak to him, you can call him directly at 310-844-7220. But remember, this is for a limited time only. We're only giving out these nightly signals on a monthly basis. If you'd like to purchase the entire course, it's $395, drop down from $495. If you have any questions concerning the actual RPS method or anything on our website or anything I explained today, you can give us a call, or if you're interested in purchasing it, we can set you up right away. And you'll have instant access, by the way. So if we get a signal tonight, you'll be able to get the signal. And I'm sure we are going to have some signals tonight as well. Okay? If there are no further questions, please be sure to call or email. You can get those results you asked for. And thank you. I apologize once again about my voice. It's a little bit raspy today, but I'll do my best to do better next time. Okay? Thank you so much for attending. Thanks to all the people at FX Street, and we shall see you next time. Okay? Bye-bye.